They waited until you were asleep. It's an old tactic, a cowardly tactic, but it's effective. Last night, while New York was dark and London was just pouring its coffee, the powers that be fired their most dangerous weapon. They didn't sell metal. They didn't announce a new mine. They didn't fix the supply chain. They changed the rules of the game. If you woke up this morning, checked your phone, and saw red candles, if you saw the price of silver smash down from its highs and you felt that pit in your stomach, that fear that here we go again, stop, breathe, because what you're looking at is not a market crash. It is an act of desperation. The exchange, the entity that is supposed to be a neutral arbiter of price, stepped in overnight and raised the margin requirements for silver futures. They made it 50% more expensive to hold a position than it was just yesterday. They tried to force liquidation. They tried to trigger a long squeeze. They tried to break your spirit before the weekend. But here's the news they didn't expect. Here's the data point that should terrify the big banks and delight every single person holding physical metal. It didn't work. In 2011, when they did this, the price collapsed 30% in a week. In 1980, when they did this, the price collapsed 50%. Today, the price flinched, it dipped, and then it stood its ground. In this deep dive, I'm going to expose exactly what a margin nuke is. I am going to show you the historical playbook they are using, word for word, from the 2011 crash, and I'm going to prove to you, using the volume data from this morning, that the smart money didn't sell the dip. They swallowed it whole. The banks fired their silver bullet, and the werewolf is still standing. This is the story of the Friday showdown. To understand why the market is red today, you have to understand the casino that is the COMEX. Most people think the price of silver is determined by two people swapping a coin. It isn't. It is determined by speculators trading futures contracts. These contracts are highly leveraged. Until yesterday, if you wanted to control 5,000 ounces of silver, you didn't need $300,000. You only needed a performance bond, or margin, of about $12,000. That's roughly 25-to-1 leverage. It allows hedge funds, day traders, and algorithms to bet massive amounts of money with very little cash down. This leverage is what allows the price to fly up. But it is also the kill switch that the exchange controls. Here's what happened last night. The CME Group issued a notice increasing that margin requirement. Let's say they raised it from $12,000 to $18,000 per contract. That doesn't sound like much, right? But imagine you're a hedge fund holding 1,000 contracts. Yesterday, you needed $12 million in cash on deposit. Today, at 2 in the morning, the exchange says you now need $18 million. You have 1 hour to wire $6 million, or resell your position. Where do you get $6 million at 2 in the morning? You don't. So, the exchange's computer automatically sells your silver contracts at market price to cover the difference. This creates a wave of artificial selling. It's not because the fund wanted to sell. It's not because the fundamentals changed. It's because the house changed the buy-in. This is the margin nuke. It is designed to flush out the weak hands, the speculators who are over-leveraged. When they sell, the price drops. When the price drops, other people panic and sell. It triggers a cascade. That was the plan. That is what they did in May 2011. They raised margins 5 times in 9 days. They hiked the cost of betting on silver by 84%. It destroyed the paper demand, and silver fell from $49 to $33. They are running the exact same play today. They looked at the 60-plus breakout. They looked at the empty vaults. They looked at the big banks' losses. And they pulled the lever, raised margins. But this time, the result was different. Why? Because the people buying silver in 2025 aren't speculators using 25-to-1 leverage. They are industrial users and sovereign nations paying cash. Tesla doesn't buy silver on margin. The Indian government doesn't buy silver on margin. They buy with full payment. So, when the exchange raises margins, the strong hands don't care. They don't get liquidated. This is why the price only dropped a few cents instead of a few dollars. The margin nuke only kills the paper speculators. It does nothing to the physical buyers. And today, the market proved that the physical buyers are now in control. I want to take you back in time, because if you don't know history, this red candle today will scare you out of your position. The date was Sunday, May 1st, 2011. Osama bin Laden had just been killed. The news cycle was chaotic. Silver had just touched 49.50. It was a parabolic run. Everyone was euphoric. Then, under the cover of darkness, the CME Group announced a margin hike. They raised the maintenance margin by 13%. On Monday, silver dropped $5. The next day, they raised it again. On Wednesday, they raised it again. By Friday, they had raised margins 5 separate times. They beat the market into submission. They forced the liquidation of billions of dollars of long positions. It worked. The price crashed, and it entered a bear market that lasted for years. The banks are relying on your muscle memory of that event. They want you to look at today's chart, remember 2011, and think, the party is over. I need to sell before it crashes. They are weaponizing your trauma. But look closer at the chart today. In 2011, the drop was violent. It was 10% in a single day. Today, we're down less than 1%. We're consolidating. Why the difference? In 2011, the rally was driven by paper demand. It was driven by hedge funds buying futures contracts and SLV options. There was no shortage of physical metal in 2011. The vaults were full. So, when they killed the paper demand, the price collapsed. In 2025, this rally is driven by physical depletion. We have a 1.1 billion ounce deficit. The vaults are empty. Refineries are halted. You can raise margins on paper contracts all you want. It doesn't create physical metal. This isn't just about finance. It's about physics. You can't print silver. You can't conjure ounces out of thin air by changing a rule on a computer. The physical market and the paper market have been telling two different stories for years, but now, they're having a head-on collision. The paper market tried to slam on the brakes, but the physical market is a freight train with no brakes to begin with. So what does this mean for you, the person holding a silver eagle or a 100-ounce bar? It means the game has fundamentally changed. The old tricks are losing their power. The fact that the price held up today isn't a sign of weakness. It's a monumental sign of strength. It's the market telling the manipulators, your move didn't work. For years, we've talked about the day when the physical market would overwhelm the paper market. That day may not have fully arrived, but today was the first major battle in that war, and the physical side thus held the line. The panic they wanted to induce failed. The sell-off they engineered was absorbed. The smart money, the physical buyers, saw this dip not as a reason to run, but as a discount, a fire sale, courtesy of the exchange. They bought the dip. They added to their stacks. They know that every ounce that leaves the COMEX system for a private vault is an ounce that can never be used to suppress the price again. This was a test of conviction. The over-leveraged paper gamblers failed the test, as they always do. But the real investors, the people who understand the difference between price and value, they passed with flying colors. Don't let them fool you. Don't let them scare you. The red you see today, in blood in the water, it's the flash from the cannon of a desperate enemy, and their shot just missed. The trend is intact, the fundamentals are stronger than ever, and the showdown has only just begun. Stay strong, keep stacking, and watch what happens next. Thanks for watching. If you found this breakdown valuable, hit that like button, and be sure to subscribe so you don't miss the next update. This story is far from over. See you next time.